Welcome everyone. Welcome to Bamboo Wealth Financial Planning Matters. Today we have a special guest, David Bassanese. I think that's how to pronounce it. David is a chief economist at Betashare. He mainly deals in debt, derivatives, and also monetary policy. David's previous roles have been with the Federal Treasury, OECD, and also Macquarie Bank. And currently, David still writes for the Australian Financial Review. So, David, welcome to Bamboo Wealth Financial Planning Matters. Thanks for being here. How are you today?
Good. Thanks.
Excellent. David, look, once again, thanks for coming onto our YouTube channel. I just wanted to give our viewers a background of the current environment in the context of which a lot of investors are currently experiencing. We're obviously experiencing unprecedented times at the moment. How do you think the economy will be, say, if you look forward 12 months from now?
Well, I think 12 months from now, I'd be pretty disappointed and surprised if we weren't past the virus is the big thing that's driving markets at the moment. And it's not so much the virus per se, but it's consequences of shutting down economies, employing social distancing. In terms of financial markets, I guess the biggest issue at the moment, and I think in a year's time, look, given all, if there wasn't a vaccine available, so I think the risks associated with the coronavirus should be well, and hopefully be looking at better times thereafter. Economies recovering. Equity markets, which have had a pretty explosive rebound, probably consolidating then and now, but then, probably starting to move higher in a renewed sort of bull market, certainly in 12 months' time.
Okay. So we've seen severe downturns in equity markets in March by up to 40%. How do you think that will pan out, particularly when you consider today? If you look at the NASDAQ, for example, the Dow Jones, they're almost at time or past all-time highs. Do you think that will continue, or is there more concerns on the horizon?
I say the next 3 to 6 months, and particularly given the fact that equity markets have you mentioned the NASDAQ. The NASDAQ now is at higher levels than before the coronavirus struck, back in.
That's right, yeah.
There's been quite an extraordinary rebound. And our market hasn't fully, at least half to 3/4 of the losses. Look, in the short run, I think pullback, certainly a consolidation and a decent pullback. So I personally will, at the moment, I think we're going to find that, economic growth is still going to be dealing with virus outbreaks in various countries, the risks of economic lockdown. Melbourne is back into lockdown. The chance that New South Wales could go into lockdown, a chance that some state lockdown as well. So, and corporate earnings, I think, are still going to come under somewhat downward pressure. So I think all of that, at some point, the markets have got to reflect that reality. At the moment, they've got we can get through all this and quickly, but I don't think we'll be able to get through it as quickly as markets.
Okay. In the past, we've had a couple of recessions. I mean, I think the Treasury has already come out to call we are in a recession. We had the 1970s recession, in early 70s, 1990s recession. Have the governments learned anything different in terms of overcoming this recession quicker than the last two?
Look, and obviously globally we had in the global financial crisis in 2009, but Australia, at least technically didn't go into recession.
That's right, yes.
At the time, and because China, really recovered quite smartly. The big difference this time, an economic shock. Typically recessions come about because either inflation breaks out and to, raise interest rates to slow the economy, or there's some sort of credit bubble, an asset price overvaluation, and then things sort of blow up. This time around, dealing with the virus, And so in that sense, we've seen that fiscal, governments are prepared to provide a lot of stimulus in a way that they're probably a bit more slower session. So that certainly bodes well for the recovery. And also, at the end of the day, we've built herd immunity, or one way or the other, we get past the virus with which to grow. We'll be starting at a position where unemployment is higher than we would like, and growth. So I'm pretty confident that we will get it won't be a protracted, say more than 6 months to a year. We can get over the shock we've been facing.
Yeah. And also, you mentioned the word confidence. Consumer confidence drives the markets, particularly the equity markets. How do you think, what sort of things do you think your average investor should be looking when you consider the performance of equity markets versus property markets and the current low interest rate environment? People in bonds, for example, and term deposits are obviously suffering in terms of any yield they're receiving. So what are some things that investors can consider going forward in terms of asset allocation?
Look, it's a good question. I mean, really, the reality is sort of driven interest rates to incredibly low levels. So, the sort of yields you used to get on term deposits or even income funds that invested in bonds are minuscule, terribly low. I'm seeing because inflation is going to stay low and central banks are going to keep rates low. So, look, the reality you've got to, as we say, go up the risk curve. You've got to take on a bit more risk. And really, if you can manage investment horizon, and again, depending on your situation, be it your age and your risk, advising any investment advice here. But equities, at the end of the day, still, if you're prepared to weather the gyrations of prices, in the short run, as we've seen, February and March, and then rebounded, almost as strongly over the last few weeks. Equity prices are very volatile in the short run. In the long run, they tend to trend up. And so if you can seek income through equities, to the extent you can, that's certainly worth. The one is that there's, and again, I work at an exchange traded fund business now, Betashare.
Yeah.
Ways to invest in exchange traded funds on the market, get income through things like hybrid, longer duration corporate bonds, for example, relative to, say, the traditional term deposits and things like that. So look income opportunities that do. And the thing about hybrids and bonds, I mean, when near as much, so they do offer you that defensive protection. So there's definitely sort of a look bit beyond the usual suspects these days. Look a bit harder, unfortunately.
Sure. You mentioned about looking beyond the usual suspects. Does gold play a role in clients' portfolios for asset protection or wealth preservation?
Gold,
yeah.
On and off gold. I mean, in the long run, gold, basically, I think keeps track with inflation. So high return from gold. But the beauty of gold is that it does have very low correlation with equity.
Yeah.
So, as we've seen, when equity markets have sold off over the last few years, gold tends to rally. Gold has rallied again. And in fact, gold has continued to rally even with the equity markets rebounding. Is that, again, just to reiterate, low interest rates globally, people are now using gold because basically the yield you're foregoing by not investing in, say, government bonds, particularly that low. So you're not actually losing out all that much by investing in gold compared to bonds globally. So what we're seeing globally is people starting to invest in gold as a safe haven at very low rates. So I think there is a role for gold just as a diversifier.
Yeah.
and in certain market environments, gold will give you a very strong return. Then it will give back in other conditions. As I said, over the long run, I don't expect gold to give you a high, sure, but in certain periods it can definitely do well and offset the parts of your portfolio.
Yeah. Just one more question, David. In relation to consumer confidence, we have the US federal elections coming up in November. So how do you think that will, in terms of cycles and patterns, how do you think that will impact on superannuation funds between now and end of the calendar year?
Yeah, US presidential elections aren't that, usually it's a period where equity markets are back somewhat, if you look at historically in the US. There's just to the uncertainty of, policies might be. And particularly in periods where the economy is weak as now, the grinds to a shutdown. And so, it's less likely to get it quickly during an election campaign because no one's in charge. So that's the way the markets will have some trepidation in leading up to the election. Now, whoever wins, there is some risk if Biden, obviously at the moment the polls, that could lead to some concerns about corporate tax increases in the US again, but it will shrug that off pretty quickly. But there will be some, potential weakness if Biden does win. But then again, Trump is such an erratic character as well. Maybe some relief this time if Trump doesn't win. So they'll need to, offset the worry about tax versus, at least Trump is not in power anymore. So there'd be some certainty in, say, foreign affairs. Bottom line is that it's probably going to be a short-term cause market caution, even a market pullback closer to November. But they're to live pretty well with whoever the president of the day might be.
Okay, excellent. Thanks, David. Appreciate your feedback. Any last words you'd like to contribute for today?
Again, thanks for your time. And so obviously it's a very uncertain time out there at the moment. This is probably the biggest, really, since the Great Depression. Certainly in my, decades in the financial markets. Well, people have a lot of uncertainty and concern, and this is really the time where good finance, it can come in handy. So certainly, if you need advice, and make sure you're well prepared for whatever happens in the future.
No worries. Thanks very much, David. And I would like to thank you again for my viewers for taking the time to join us today. And we appreciate your feedback, obviously your years of experience.